Imagine you're the captain of a ship. To navigate safely, you need a clear understanding of your vessel's condition, its fuel reserves, and its destination. In the world of business, financial statements serve as your compass. Section 1. Elements of financial statements. Let's break down the key elements of financial statements. Assets are resources controlled by the entity as a result of past events and from which future economic benefits are expected to flow. Liabilities are present obligations of the entity arising from past events, the settlement of which is expected to result in an outflow of resources from the entity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. Income is increases in economic benefits during the accounting period in the form of inflows or enhancements of assets, or decreases in liabilities that result in an increase in equity. Expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or increases in liabilities that result in a decrease in equity. When do we recognize or derecognize these elements? We recognize an asset, liability, equity, income, or expense when it is probable that future economic benefits will flow to or from the entity, and the element can be reliably measured. We derecognize an asset when its economic benefits are exhausted or when it is transferred to another entity. How do we measure these elements? Assets are measured at the cost of acquisition, while liabilities are measured at the fair value of the consideration given at the time of acquisition. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between informed, willing parties. So let's briefly discuss some other measurement bases you might come across, like amortized cost and present value. These bases are essential for understanding how assets and liabilities are valued over time. Now you might be wondering, how do we present and disclose these elements? Well, it's all about clarity and transparency to ensure that stakeholders can make informed decisions. Finally, let's break down the components of financial statements. We have the income statement, which shows the company's profitability. Then there's the balance sheet, providing a snapshot of the company's financial position. The cash flow statement tracks the inflow and outflow of cash, and the notes offer detailed explanations and additional information. Each of these components plays a crucial role in painting a full picture of a company's financial health. So, let's talk about the importance of disclosure, shall we? It's really crucial in providing relevant information to users. You see, disclosures ensure transparency and help users make informed decisions. They play a key role in maintaining trust and credibility in financial reporting. What is capital, and how do we maintain it? Define capital as the net assets or residual interest in the assets of the entity after deducting liabilities. Explain the different concepts of capital maintenance, financial capital, physical capital, and operating capital. Understanding financial statements is crucial for making informed decisions. By knowing the elements, their recognition and derecognition, measurement, presentation, and the concept of capital maintenance, you'll be well equipped to navigate the financial world.